Okay, good afternoon, everybody. Let's go ahead and get started. I want to welcome everybody here. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that that is indeed working. Hope everybody's in a fantastic afternoon so far. It was great to see a lot of you guys in the live trading call this morning for Forex, and looking forward to our live options trading call today. This is our first one, which I'm excited about, that we've done as a group. So last week we did cover a lot of the basics of buying options, selling options. We talked about the difference between a call option and a put option, and did a lot of curriculum. Today we're going to do a little bit more application. We're going to try to go slow. We will be taking a trade before the end of the call, which will be awesome. And so that's the game plan today. We're gonna go over a lot of today. What I thought we would start off by doing is actually looking at an option chain, one that we're interested in and one that we're gonna take a trade on today, and and just kind of show you what it means to read an option chain, how to discover different prices and the difference in premium, the strategy behind it. The strategy is what we'll probably do in the middle segment. I'm going to teach you guys a option trading strategy, and then at the end we're going to execute the first leg of that strategy through taking a position in a trade that will open today, and then we'll review next week, which will be super awesome. And then if I need to make any changes with that trade throughout the week, I will let you guys know. But yeah, it's super exciting. So yeah, let's freaking go, Paul. Like, super excited to have you guys here. And like I said, want to give a shout out to those of you who are watching this in the recording on the website and those here live, and also those of you who may be watching this on YouTube. So we want to say hello to you guys as well. Okay, let's go ahead and jump into this. Before we get started, I do need to remind everybody about the risks associated in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how much risk you're taking on each trade. Another thing I want to make sure everyone's aware of is I am not a financial advisor. I don't give out financial advice. These are my own trades and my own information that I like to share. And so, please take the information that I share with you with a grain of salt. Like, I wouldn't, if you're looking for a financial advisor, definitely go seek one out, because I'm not a registered one. So keep that in mind, and be aware of the risks associated. We're going to do our best to manage risk well. We're going to do our best to, take care of the things that we do, and making sure that we don't risk more than we're willing to lose, all that kind of good stuff. But yeah, we'll go ahead and jump into this. Okay. So, like I said, last week we reviewed difference between calls and puts. Tonight, here, let's actually review this. So tonight we have a class on the Greeks. Okay. It's class 3 of 10. That's going to begin tonight at 9 p.m. Eastern, 7 p.m. Mountain. So if you want to come to that class, make sure that you show up to that. That'll be tonight. We're going to talk a little bit about the Greeks today, just because that is required for some of the live trading that we're going to be doing. So I'll try to do my best to ad lib what's important with taking our trades today. However, we're going to continue our course that we have, that's going to go all the way out until March. And then I'm thinking about just every 12 weeks or every 10 weeks, just restarting the course. So we're just going to keep doing a loop and doing it all over again. But we got to get through the course through the first, through its first round right now. And so I don't have a lot of recordings to send everybody except for the 2 or 3 that we've done so far. And then obviously tonight we'll do another one, which will be great. Okay. So let's do some fun stuff to get started. As a group, we've never looked at an option chain together. And so I wanted to show you what a option chain looks like, because it's one of the I feel like it's one of the most intimidating things to look at. It's like, it's so different from looking at a chart. Like, if you pull it, like, here's a SoFi, we're looking at SoFi right here. This is the SoFi chart right now on an hourly time frame. And this is like more of what we're used to looking at, like when we're looking at Forex positions or futures contracts. But this is a stock, right? Like, this is a financial, let's see, this is a banking fintech. That's what you call it. Fintech stock. SoFi. It's one of my favorite fintech stocks. And So yeah, this is what we're used to. So an option chain looks like this. So I'm on Robinhood over here. I've got SoFi pulled up. It gives you a little profile of their company, and Robinhood's cool because they give you an advanced trading chart and things to look at. And then down here you can see more about the company. It tells you like, okay, SoFi is a financial tech company, and they have been around since 2011. So they're kind of a newer company. Their headquarters in San Francisco, California. Uh, 5,000 employees. There's a CEO. And then down here are the like key statistics, their market cap, their volume, their 52-week high and 52-week low. You can look at, let's see, there's other metrics that are important to look at, like price earnings ratio and stuff like that if you're an investor. Down here, you've got like key news, things that are going on with SoFi to be aware of. You've got their let's see their earnings and stuff like that. So anyway, pretty cool. So where do you trade options? Well, first of all, how do you like just buy and sell the stock? Like if you wanted to buy shares, you would just come over here on Robinhood and you can click buy or you can click short and you can put in the number of shares. Right now, SoFi is trading for $22.51. Okay, per share. And so if you wanted to trade options, you would click this button right here. It says trade SoFi options. You'd click that, and then you could go ahead and change like what you wanted to do. But first of all, before we do any of that, this is an options chain. This is what it looks like. It'll say, right here you've got like you can buy, you can sell, you got calls versus puts, and then you can also change the expiration date. Okay. And all of these things are really, really important, but it will make sense in time. And everything has to do with your strategy. Are you buying puts today? Are you selling puts? Are you buying calls? Are you selling calls? Right? And you got to kind of have an idea of what you want to do, what your intention is, and that all comes down to your strategy, which we're going to get to in just a second. But let's talk about like the easiest type of option trade first. So like a call option where you buy a call is the right to exercise at a strike price at a particular expiration. So right now you can see SoFi is trading at $22.51. So an at the money call option would basically be $22.50 right here. So if I click this and I leave the expiration for 4 days out. So the options always expire on Fridays. So on Friday, this option will expire. But if I bought this at the money call right now, it's going to cost me 58 cents per share, 57 cents per share. And essentially what we're saying is if by Friday SoFi is above $22.50, I get the right to buy at $22.50. So let's say SoFi went up a ton between now and Friday. Like it went from $22.50 and we went up to like $26. Okay. That means I get to buy SoFi at 22.50 even though the price is at $26, which is amazing, right? Like I'm going to make all that profit. And the way you'd figure this out is you just pull up a calculator. I'd suggest having one at your desk if you've got one there, or just using the one on your computer that's local. And an easy way to figure this out is you would just to kind of simulate this is you could you know say let's say SoFi was at $26 by Friday, then you would subtract it by your strike price, which is 22.50 minus 22.5, and you would make $3.50 per share because you could turn around and close your position on SoFi immediately and sell it at market at $26 per share, even though you purchased them for 22.50, which is really cool. So if price goes up a lot, that's going to be very beneficial to buying a call. Now, because that's $3.50 per share. Now, let's say that SoFi goes down instead. Let's say you buy this call and it goes down. What happens if SoFi goes from 22.50 to $20 by Friday? Well, you wouldn't want to exercise your option, your right to buy shares of SoFi. You wouldn't want to exercise that because the price is too low. Like, right? Like you wouldn't do that. Nobody would ever do that because you could just, if you wanted to buy SoFi, you could just buy at the current price, which is lower than your strike price. So what happens in that situation? Well, you just lose your premium. So that's the downside to that is the downside to buying options is If the market doesn't do what you think is going to happen, you lose the premium that you paid for that, right? So this one's 4 days out. So this is not a super expensive option. It's 55 cents right now per share, and you have to buy 100 of these at a time. So that would probably cost us around $55 if we wanted to buy that option and have that right for that. Now, let's say we go out further in expiration. I want you guys to see the relationship on an option chain here. If I change this, and by the way, I put this in my cart. Anytime I click this button, it puts it in my cart. So we got to remove it out of our shopping cart. Have you ever put stuff in your Amazon cart and you accidentally put it there and you didn't realize, and then you go check out and you realized you purchased everything on your wish list? Yeah, so don't do that in options. You can easily do that. Like if I click each one of these, boom, 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 and I just click all these, it's going to add all of these to my cart, and I don't necessarily want all those in my cart, right? So you have to be careful and you have to go back and check before you take a trade to make sure you don't have too many things in your cart because you can buy as much as you want, right? And anyway, we want to do everything according to our strategy. Now, I want to show you the relationship of what happens if you change the expiration date on an option chain further out. Let's say we go from 4 days out and let's do something that looks like a month out. Let's do March 6th. That's 32 days away. And watch these options become a lot more expensive. Okay, so here's an at the money call. Well, it's close to at the money as you can get, right? ATM. So $22 or 23. Both of these would be, I mean, this one is in the money slightly by 47 cents. This one's out of the money by like 53 cents. Both of these would be considered an at the money call option, or as close to at the money as you can get because there is no $22.47 call option right now for 32 days out. You can either buy the 23 or you can buy the 22. It just depends on which one you want to buy. If you buy the 22, it's going to be more expensive because it does have a little bit of intrinsic value, which we talked about last week. And then the $23 one is just slightly out of the money by 53 cents. So it has a little bit more extrinsic value and therefore it's less expensive. So another thing to keep in mind, like when you're looking at the relationship between buying out of the money call options or buying in the money call options, right? Something to keep in mind. Okay. So right now, this is just an exercise to understand the relationship between like how the option chain functions, the cost of premium, all that kind of stuff, right? Time is money. So because time is money, I want you to see what happens when we change the expiration date. So remember, in fact, I'll go back to this just for a second. Remember, if I buy an at the money call option right here at $22.50, this is going to cost me 55 cents per share if I want to have the expiration on Friday. Now, if I want to change this to 32 days out, let me go ahead and remove that out of my cart and let's go 32 days out instead. And I buy it at the money or as close to at the money as I can. Let's do the $23 share price. Now the premium is going to be, if I put that in my cart, it's $1.22 per share. So it's more than double the price. Why is it more than double the price now? Well, the reason why is because we went out, instead of going out 4 days and having the expiration be this Friday, we're going out 32 days and time is money. And so somebody's going to have to sell that to me if I'm going to buy this, right? And if they're going to sell that to me, time is money. And so they want to make sure that they're earning more money on something that they have to wait 32 days to fully collect the premium from. Because remember, for every buyer, there's a seller. So if I'm buying this call option, somebody has to turn around and sell it to me. You never know the person. You don't shake hands with the person who you sell it to. The broker figures that out. They've got orders on standby that they can just issue to you, whether you're the buyer or the seller. And so you don't have to worry about like finding a buyer or finding a seller. It's just already factored in to the bid and ask price. So when you just go in and execute, it's ready to go. Okay. Okay. So time is money, right? So this is 32 days out. It's going to cost me more to buy that. Now watch what happens to not let's leave the expiration out for 32 days from now. Let's go ahead and remove this. Watch what happens if I go down the option chain. On a call option, when I'm buying a call, if I go further down the chain, this is like a vertical move. If I go down the chain to things like, $20, or if I go to 19, and I click on that, notice how the price gets so much bigger. Okay, that's going to cost me $4.65 to buy that one. Why? That's a deep in the money call option. Okay, why is it called deep in the money? Or just, I mean, you could just call it in the money. I consider that deep in the money because the market would have to fall like 20%, 25%, 30% or so to get to your strike price, right? So that's called a deep in the money call option because the market would basically have to fall pretty far to make your option lose its intrinsic value because currently this is already intrinsically valuable because it's deep in the money. Essentially, like I said, the market would have to fall very hard to lose all the value of this option. Okay. It would take a lot of movement. Some crazy things would have to happen to SoFi in order for that to become invaluable, to lose money. In fact, I'm going to teach you one quick thing. I know it's for the lesson tonight, but if you click on this call option, you're going to notice a thing called delta right here. The delta is basically the chance of success. Not just the chance of success, it's the chance that this option will expire in the money. So right here we have an 84.44% delta. And what that's essentially saying is that this option has we'll call it 84% chance of expiring valuable. Like there's a real, essentially this option is not guaranteed because there is a 15 or 16% chance that it will expire worthless, but there is an 85% chance here that it will be successful. And so that's why it's a more expensive option. We're not going to talk about this today, but in the future, I'm going to teach you guys some ways to do some long-term investing with call options. So they're called leaps options. Basically, you buy options that are like stocks that you believe in. Let's say you buy Microsoft, you buy Apple, and you buy a year out expiration, and then you go deep in the money on Microsoft, you go deep in the money on Apple, and essentially you have like, an 80, 85, 90% delta on those. There's the chance of success is very, very high. But why would you buy a deep in the money option? Well, you would buy it because you're buying intrinsic value. And so if you're just an investor that wants to kind of mimic the stock price going up and down, leaps options are a great way to do that. We haven't talked about those yet. We are going to have a unit on leaps options and how to be a long-term investor where you buy deep in the money calls. But the reason why I'm bringing that up right now is because we're going down the line, right? Down the vertical here. Now, what happens if I go up the line here? Watch how inexpensive these become. So remember, these are very expensive because they have intrinsic value. Now, if I go up the line from the share prices where the market's at right now, the further I go up, look how inexpensive these become. These are like lotto tickets. Why do I say that? Well, like for example, this one's $30 a share in 32 days. Currently, the price is at $22.45. So if I buy that out of the money OTM call option, if I click that, it's only going to cost me 14 cents a share. It's like hardly anything. It doesn't cost a lot at all. Now, if SoFi goes on a tear, let's say, I don't know, some great news comes out and the company is just on a rampage and it looks like they're just gonna take over the entire banking industry and it's just crazy awesome things happen. I don't know, could happen. Stuff happens, right? And this stock goes over $30 a share within 32 days. By 32 days, I can exercise this and I can buy SoFi shares at $30 a share. And that's going to benefit me, especially if SoFi goes well beyond that. Let's say it goes to $35 or it goes to $50, by that time. Very unlikely. You want to know how unlikely that's, you know what? You want to know how unlikely that is? If you click on this, here's the delta right here. It has a 7% chance of expiring in the money. So that means it has a 93% chance of being unsuccessful. Okay. That means that it will expire out of the money and it won't be worthwhile to you. So why would somebody buy one of these? Well, if you expected something big to happen to a stock and you wanted the cheapest option possible, you would buy an out of the money call option. to see if the share price could increase quickly. And if you knew something about the stock or you had a good hunch that that thing was going to go off pretty hard, you would buy these out of the money call options. Now, I don't typically do that. These are really hard to succeed with. They cost money. They don't cost a lot of money. But you can go out and buy a ton of these and you can lose a lot of money really quickly, especially when you're only winning, 7% of the time. That's really tough. So I don't usually buy those, but you can see as you come closer in the money, like for example, this one is basically at the money at $23. Chance of success, 48. So it's basically a toss up. Whenever you buy at the money calls or at the money puts, delta is usually going to be around 50%. And so, almost always, like if you click on this one, yeah, that one's 59%. And then the further out you go, it changes. Like if you go in the money like these are, 81% chance of success, uh, that it will expire in the money. If you buy these ones, like here's $25, 28% chance of success. So it's kind of an interesting thing. We'll talk more about that tonight when we get into the Greeks, because that's a really important topic. And it makes things easier. Like when you click in, when you're considering buying an option, it's nice to have like some kind of, I mean, these aren't going to be perfect. They're never perfect, but it's nice to have some kind of a metric that you can follow there that kind of gives you an idea like, hey, what's the chance of success here? You know, am I likely to be successful with this option trade that I'm about to take? So, okay. So, let's see. Any questions on the option chain so far? There's a lot to talk about. One other cool thing that I like about Robinhood is it's really beginner friendly because if you click on this builder button right here, you can build out your option strategy. So they have single legs right here. So if I click this and just click long call, it's going to allow me to buy a long call. If you want to do like a cash secured put option, it will build that out for you. You can also do what's called vertical spreads, which we have not talked about. We have a unit coming up on vertical spreads soon. And basically, this is where you can buy call debit spreads, put debit spreads, call credit spreads, and call put spreads. And we'll show you what each one of those are. But like you could click on one of these and like if you want, I like to do these put credit spreads, especially if I'm bullish on a stock. Basically, what this will do is it will build out a spread for me. This is just too advanced stuff, but basically, it builds out an opportunity for me to be bullish on a stock, where I basically sell one put and I buy another put as insurance. And then the idea is that as long as that option expires worthless, I get to keep the credit, which is super nice. We haven't gotten that. That's a little deep. Probably shouldn't go down that route. But another thing too is you can learn about like buying straddles and strangles. You can build those out in here in Robinhood, which is kind of cool. Now, if you don't want to use the builder, this is like for people who are kind of brand new, which is kind of nice. You'll graduate from this pretty quickly once you learn how to build your own options. You might just build them without using the builder. But the builder is nice because it kind of like it's kind of like when you go bowling, you can put up the guardrails for your kid. If you have I don't have any kids, but like sometimes I'll go bowling with my niece and nephew and they like to use the little guardrails, like you pop them up and then you go bowling and I don't like to use that because I feel like it's cheating. Right? If it goes down the alley, it goes down the alley, right? Like if it just or if it goes down the gutter in the gutter, it's whatever. But the kids like it because, it helps them kind of keep, you know, makes it so that they have a fun time bowling. Otherwise, they'd probably get bored pretty quick. Um, Same thing here. When you use the builder, it's kind of nice so that you kind of keep within the strategy guidelines. That's what the builder does. Kind of nice. Okay. So now what I wanted to do, let's go to our middle segment here. I want to teach you guys a strategy on how to build income with options. Okay. So what we're going to learn today is a really simple, well, I think it's a simple strategy. It's called the will strategy. Okay. How many curious to find out has anybody heard about this strategy before? Like, have you done any study on this? Have you come across this? Um, I know some of you might be familiar with options and some of you might be kind of like not that familiar, but if you have, let us know in the chat box, or if you're watching this on YouTube, let us know in the comment section if you've um, heard of the wheel strategy before. So let me kind of go over what the wheel strategy is. So this is a system where you're trying to build weekly income from the options market. Okay, and whenever we talk about income, usually that means we're selling options. Okay, so I like to be on the sell side of options. I know some people prefer the buy side, and buy side is fun. The buy side of the market is a lot more exciting because there's potential for huge moves. But I like the income side because I want that consistent income over time. And if you trade this the right way, the income side is a great side to be on. There are times to buy options, like I'm buying puts on IBIT right now because I'm shorting Bitcoin. In the future, I'll probably do some leaps options on IBIT because I'm going to be bullish on Bitcoin again at some point in the future. And then, there's other stocks right now that I own call options on as well. So that I definitely buy it. I'm not trying to say that you should never buy or sell options, or excuse me, I'm not saying that you shouldn't ever, like, sometimes it makes sense to buy calls and buy puts, but I think 70% of the time you should be selling options. Okay. And doing selling strategies. So that would be like iron condors, iron butterflies, the wheel strategy. This is where you want to be. So let me kind of go over the thesis behind the wheel strategy. The wheel strategy is basically where you're selling puts to start. Okay. The reason why you're selling puts is because you're collecting income on a stock that you believe in. Okay. And the reason why you want to sell puts is because eventually, if you keep selling puts, you're going to get assigned. Now, let me explain what assignment is. Whenever you sell an option to somebody, like I sell a put, I'm collecting a premium because I'm selling this to somebody else. Now, what happens if I sell this and let's say the market drops? Let's say I sell a put option at $22 on SoFi. Okay. And SoFi drops below $22 at my expiration. I'm going to get assigned to purchase SoFi. That means I'm at the expiration date, I'm going to have to buy SoFi at whatever the strike price was, because somebody who I sold this to is going to want to exercise their right to that option, and thus I'm going to get assigned. Okay. I've never seen a time where somebody has not gotten assigned. I've always been assigned if I allow my put option to go to expiration and the price is below my strike. I've always gotten assigned. Um, Sometimes you won't get assigned if the market, in fact, always you won't get assigned if the market is above the strike price. Okay. And the reason why is because if you're selling a put, nobody wants to sell at a lower price. They always want to sell at the higher price. Okay. So let's continue on here. So you're selling puts. And the purpose behind selling puts is to just constantly collect premium. And the premiums can be really juicy. And I'm going to show you some examples specifically with SoFi on how juicy those premiums can be when you're selling. You can collect a lot of premium and make a lot of income just from collecting premiums if you do it right. Now, like I said, eventually you're going to get assigned, which means you're going to be a buyer now. And technically, selling puts is a bullish strategy. Why is selling puts a bullish strategy? Because you're selling the right to sell a stock to somebody else. And so, therefore, you're hoping that the stock stays elevated or stays sideways. As long as it stays elevated or sideways, you're going to make money selling puts because you're always selling the right to sell to somebody else, and that never happens. Like the market never goes down, and so you're constantly collecting that premium. That's the purpose behind selling puts. Okay. Now there's risk with this though, quite a bit of risk actually selling puts. Let me talk about the risks about selling puts. When you sell a put and that stock collapses, which can happen, that happened to me on a stock this last week. Now it's recovering this week, and I'm actually going to roll that option. And I don't know if we'll have time to talk about what rolling is today, but I've had to roll that option out to a further expiration to avoid taking a a big hit on that stock. And actually, the stock did come back up today quite a bit, so I'm like it's looking a lot more likely that I'm going to collect premium and it's going to be just fine, no problem. So anyway, and maybe I can even show you the stock that I got stuck on. And it's easy to fix. Like it is actually an easy thing to fix. There's tons of options, pun intended, right? To fix a lot of these trades. But anyway, we're going to get to that in just a second. Let's finish the concept here. And then maybe we can talk more about the risks and the profits associated after we finish the concept. Okay, so you sell puts, eventually you get assigned. That brings us to step two. Okay. You get assigned shares. You have to buy 100 shares of, let's say, SoFi stock. Okay. And you have to buy SoFi now at the strike price. Now, you own SoFi. So what do you do now? Well, now you turn to step three. And so step two is a really quick thing because you're now, once you're assigned, and now you have, now you literally own SoFi at the strike price. So now you have to turn around and go to step three, and that's where you sell call options. These are called covered calls. This is actually selling covered calls is the safest form of options trading on planet Earth. Like literally, there's nothing safer than selling call options. It is the safest thing. And the reason why is because they're covered. And what does that mean? It means that there's collateral behind the call option. It means like if you sell an option, if you sell a call to somebody, you're collecting premium. Okay. And you also own the underlying asset. So if that asset goes to the moon, yes, you're going to be on the hook to give that asset away to somebody, but you're going to collect appreciation all the way up to your strike price plus collect the premium. Let me explain that concept a little bit better. So once you are assigned shares in step two, you then immediately turn around, and I usually like to go a week or two out to sell calls to other people. So I'll go ahead and sell calls now that I own the shares of SoFi. So let's say SoFi is at $22 a share. I got assigned at $22. And now I sell the $23 call option that's a week out. I'm going to collect that premium. And if SoFi goes over $23 in that period of time, my shares are going to get called away from me. And I'm also going to collect my premium in step three for selling that call option. And then I'm going to go back and return to selling puts again. And that's why it's called the will, because you're somewhere between step one and four. Okay. So, so like, let me explain this again. I'm hoping because I'm sure there's somebody out there that's like, I'm not getting it yet. So let me kind of, I'm going to try to make some more examples of this. So again, let me finish explaining step three and we'll go to step four again. So basically in step three, you're you own the stock at this point because you've been assigned because eventually the stock falls from step one. You get assigned shares because somebody is going to exercise their put against you. And so you're going to be forced to buy SoFi at that strike price. Now, you're going to earn that, right? Because you earn premium. It's not like they're going to force you just to force you. They forced you because you sold a put to somebody, right? And then they were correct in selling that put or buying that put from you. You collected premium, but now you're assigned. And even like even if like let's say the market goes exactly to your put price, your strike price at $22, you're going to get assigned even if the market's exactly or even just a penny below that. And so you might be really happy because you collected all this premium. You might have to buy SoFi at $22 a share, even if it's trending at $21.99 per share. You're still going to have to purchase SoFi at $22. But you're not mad at all because you still collected that premium. Okay. So like I said, you're going to get it assigned at some point, and that's the perfect time to get assigned is as long as the market's basically at your strike price. You get assigned. Now you own the stock, and then you then turn around in the same day and you sell a call option for a week or two out, and you collect that premium immediately for selling that call option. Then you wait the 1 to 2 weeks for that to expire. If the stock goes back up above the call option strike price, you're going to have to surrender those shares. But the beauty of that, though, is that you get to collect the appreciation of those shares all the way up to the strike price plus the premium collected. So let's do some examples of this on a real life example. So let's actually head over here to the option chain on SoFi. And we're making good timing here. I think this is really good. This is going to be easier if we just explain this doing a real life example. Okay. Because in a minute here, we're going to take this trade. All right. So let's go ahead on SoFi here. Let's click sell and we're going to sell a put. This is going to be a cash secured put. And let's go 4 days out. Let's go with the expiration of this Friday. I like to do a week out or 2 weeks out. Maybe we'll even do, let's actually see let's shop around a second. Let's see what the premium difference is. So if I sell an at the money, I usually don't go at the money. I like to do like a 30% delta. So if I head down here, you can see this says 38%. If I go to the 2150, that's almost exactly 30. So I usually do the 30% delta. That basically means that there's a 30% chance that this option will expire in the money for somebody else. And there's a 70% chance that it will expire worthless, which is good for me because I'm just trying to collect premium. I'm trying to build income, right?
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
So that's and we'll talk more about that tonight. But I usually when I do the wheel strategy, I do I like to be around the 30% delta. And so what I'll do is I'll come in here and so let's go ahead and sell this one and we'll put that in the shopping cart. Now, how much are we going to make here? 42 cents per share if I sell that, and that expires in 11 days, okay? So I'm going to collect 42 cents, so 0.42 times 100 is going to be $42 because every option is done in 100 shares. So I'm going to collect $42 in premium for selling a put to somebody at the 2150 strike. Now I'm going to have to write some of this down because I'm going to lose my, actually, let's write it down over here. Let's actually do it right on this chart. So let's do this again. The price of the market is right here at 2148. Okay. And we're going to sell the expiration February 13th in 11 days at 42 cents. That's 2150. Okay. So if the market goes below 2150 in 11 days, which puts us like right there, pretty close to right there, then our shares are going to get called away at 2150. Now, remember, we're going to collect. Let's go ahead and type this out. So 2150 put, and we're going to collect $42 in premium. Actually, let's do it by cents. So 42 cents is our put premium. Okay, and remember we're selling the put. Sell put. So we're going to get 21 cents for that. So where's our cost basis on this trade? So since we're collecting 42 cents in premium for selling the $21.50 put, this will actually tell you right here, break even is at $21.08. So SoFi would have to drop below 21.8 for us to even lose money. Okay. Because it could even go below our strike price and we're still okay because we're collecting premium for selling this put to somebody else. Okay. So we're going to get $42 for that. And that puts our break even at 21.08. Now we'll come back to that in a second. Just keep that in mind. I'm going to keep this the way we have it. So now let's like continue on and let's say that this does get triggered. Okay, let's say that the market continues down and it goes to 2150 in 11 days, which puts us like basically February 11th is like right there. We don't want to put that on there. That's going to make things noisy, but let's say it goes to there. Now our share is going to get called away at 2150. Okay, so immediately, and remember, this is step one. Let's label that step one. Okay, now we're going to move to step two, which is on February 11th, we're going to get assigned 100 shares of SoFi and at 2150. Okay. And we have to buy this, guys, because we sold the right to somebody else. This is required. This is in order for us to collect premium, we have to be willing to do this. So now, if you like this stock and you love the stock and you are willing to hold on to this stock for a while, this is going to be awesome for you. Okay. But if you don't like SoFi or if it's not a company that you believe in long term, you're going to hate doing this. So you only want to do this with stocks that you're okay holding on to in case the market does drop or go against you. Because right now we're just trying to collect premium. But if the market drops a lot, you might have to roll the option later, which I'll explain what that is. Or if it drops, like I said, eventually you're going to get assigned. An assignment is okay. Like I want to get assigned at some point so that I can start selling calls. And I actually think now is a good time to get assigned on SoFi just because the market's dropped recently. And I do think that I think it's gonna recover, especially we're coming down into some support right now. Anyway, there's some other reasons for that. But so I don't mind getting assigned on a stock that I believe in. So anyway, now we're into step two. Okay. Step two, we are assigned at 2150 to buy. And then that's really all step two is. You're just assigned at this price. Okay. And up to this point, what have we done? We've collected 42 cents in premium and we now own shares of SoFi. Instead of being a cash secured put, we now own shares of SoFi at 2150. Okay. And then what happens next is we move on to step three. Okay, let's keep going. Step three, which is where we sell a call. And we're going to go back to the option chain to shop for this real quick. So step three, we go and sell covered call. And now we got to figure out a price we're going to do that. So let's go back to the option chain. And this isn't like these are going to change in 2 weeks, right? Like the prices. But let's just shop around. Like I usually do one that's like 30% delta. So like if I sold this one, let's see, we want to sell a call instead, and let's just do 11 days out. That's fine. And let's see, if I click on this one, it'll say Delta 34. That's fine. That's close enough. We can do this one, Delta 27. That's a little too far, I'd say, just because I want to collect some juicy premium. The closer to the money you can get, the more premium you're going to make, right? So let's do that one. Let's do the $23.50 call. Now, if the price were to drop in the next couple of weeks, that one's not going to be as pricey. Like you wouldn't make as much money on it, but you could sell maybe like the $22.50 one, or you could sell the $23 one, and those would become more pricey, especially as the market drops. So let's do this one right here. Let's do the $23.50 call, and we're going to sell this one. So we're going to collect 45 cents per share for selling that call. So 23.50 at 45. So we'll go back over here and we now sell the $23.53 call. And let's just say we go um for, and then again, that's for 45 cents. Okay. And so the market would have to go up to this price now, 23.50, for your shares to get called away from you right there for step three to happen. Okay. Or for not step three, for step four to happen, which is the next step, which is where now we move on to step four. Let's say 11 days out, this option expires. And let's say SoFi does go up a lot. It goes up to $23.50. Your shares get called away. They're going to get taken from you. Why are they going to get taken from you? Because if you sell a call to somebody, you sell them the right to buy those shares at that strike price at the expiration. And so you're going to have to surrender those shares. But it's a great thing. I love it when this happens. Which is brings us to step four. Step four is awesome because that concludes the will. Because now you've sold the put, made money on the premium on the downside. You've sold the call in step three. You've made money from the premium on the upside. And you also collect the appreciation of the stock from where you got assigned all the way up to your strike price where you sold that call. So let's go over our earnings here in step four. So step four again, what is step four? That is this right here. That's where your stock gets called right away and you return to a cash position. Okay. So what does that look like? Okay, let's go back over here. So what have we done so far? Again, and let's go back to this. So step four, stock gets called away and return to cash and restart the wheel strategy. You just keep going down the wheel, through the steps. Okay. So, how much have we made so far doing this? This is probably what, a month, about a month's time, because we sell a put 14 days out and we get assigned. We sell on a call 14 days out, collect premium, and then our stock gets called away. Okay. So, what have we made so far? Well, we've made in premium 45 cents per share from the call, and we've made 42 cents per share from the put. That's 87 cents per share from selling premium in about a month. Okay. So approximately a month's time, we've made 87 cents per share. That's not even from price going up or price going down. That's just collecting premium from selling options both on the sell side and on the buy side. You're collecting 87 cents per share. Okay, let's remember that. I'm going to move that over here, move that, and we need to do some more math. Now, remember, we purchased in step two 100 shares of SoFi at $21.50. Okay. So that is our cost basis for SoFi is 21.50. Okay. Then in the following 2 weeks, after we got assigned, the stock starts to go back up again and it goes up to 23.50 or even beyond. It could go beyond 23.50, but you can't make anything beyond 23.50 because you sold a premium, right? So now the stock goes to 23.50 from 21.50. So if you take 23.50 minus our entry of 21.50, that means you make $2 per share in appreciation. Okay. So you make $2 in appreciation because you can't make more than that, right? Because let's say the stock goes up to $26, you don't get to make from 23.50 to 26. The person who bought the call from you gets to make that part. So you don't get to make that. You only get to make up to your like if you sold the call in step three, that's what you get to make up to. So to your strike. So you made $2 in appreciation plus the 87 cents, right? So if you made 2.0 plus 0.8 or 0.87, you made $2.87 per share. Okay. So basically, we made 87 cents from the selling side of puts and the selling of the call. and then you made an extra $2 from the appreciation. That's $2.87 total in about a month's time. Now look how cool this is. If the price of the stock, like if you had to tie up $21.50 to purchase SoFi, think of it this way. Your return on the share on each share is $2.87. If you divide that by 21.50 because that was your cost basis to get into SoFi, and then you multiply that by 100, that means you made a 13.34% return in a month from SoFi. Crazy, right? Like that's crazy. Like and a lot of that comes from the premium. I know some of that's also from the actually a lot of it also comes from the appreciation, assuming SoFi does go back up. But like like I've had months where you can make 13, 14, 15% in a month. You're not going to do that every month. In fact, it's most people I know that trade the wheel strategy in a year will average somewhere between a 3 to 6% return a month. Because there's going to be some months where the stock keeps going down. And there's strategies and things you can work with. You can roll the option and do some things like that to fix it. Like in some months, the stock's going to go crazy high and you're capped, right? You can only make up to your strike price plus your premium, right? And so if the stock ends up going crazy and you end up missing out on a lot of that return, it stinks to miss out on that. But yeah, you can see if like the market just kind of goes sideways, this is a great opportunity because if it goes sideways, you're just collecting premium. If the market kind of goes like sideways or even slightly up, that's the best stock to do that. So a lot of people like to do the wheel strategy with blue chip stocks. So if you buy like Microsoft, Apple, Coca-Cola, just big time, big companies that people believe in that just generally go up over time or even sideways and only have few periods every once in a while where they drop a lot, that's a great place to be employing the wheel strategy. Okay. So I hope that makes sense. That's what we're going to do today. We have like 10 minutes left to go take the trade, but we're going to start step one of the wheel strategy. And for the next week or two, we're going to come back and report to see what we've made, what we've lost. We're going to come back and report like, what do we roll the strategy, which we didn't have time to talk about rolling today. Plus it's a little bit more advanced. We'll talk about rolling in another webinar. Maybe that's a good homework assignment. Go look up videos on rolling options and learning what that means. And that will help you kind of see what it's like to handle like very volatile weeks. Because if the market's very volatile, let's say SoFi drops a ton very quickly, you might be forced, not forced, but you might want to, instead of being assigned, you can avoid assignment in step two by rolling the option, which is something I did this week actually with one of the stocks that I own or one of the puts that I sold. Instead of being assigned at the current price, I've just rolled it out a couple more weeks to see if I can collect some more premium before I get assigned. So anyway, there's some cool things that you can do that way, which we'll talk about later. But this is really cool. Like on a month like this, and this happens quite often, where the market just kind of goes sideways. Maybe it goes a little bit down enough to assign you into the stock, and then the market goes back up again. You can make money from the put side sell, from the buy side call, and from the appreciation. So you get three income streams from owning the stock, and potentially four because if you own the stock long enough, you can collect dividends as well. So there's potentially four income streams from just one strategy. So I love it because it's just like it's an income machine is what it is, which is really, really cool. Okay, so let's go ahead and take a trade together. Let's start step one of the wheel strategy. And any questions up to this point? If not, if I lost you, I'm sorry. You can come back and watch the recording. And I'm sure this is not the only time we're going to talk about this. So let's do this. So, by the way, this thesis, I mentioned this before, but this only works if you get into a stock that you believe in. I love SoFi stock. I think it's a great place. I also love the premiums that SoFi offers. There's a lot of open interest in SoFi. A lot of people trade options on SoFi. It's very liquid stock that way. And so I like it. I also like the levels that we're at right now as far as selling puts. I don't think we're going to go much lower. And if we do, I don't mind even owning the stock and getting assigned. Like if I get assigned, that's fine. I want to own this stock. And so if I sell a put and I end up having to purchase it, dang it, I have to buy SoFi because I love SoFi, right? So that's the thesis behind it. If you basically sell puts on stuff you don't care about, you're going to hate this strategy. But if you sell puts on companies that you don't mind owning and you're okay owning over several months at a time, um, that's good because there are going to be some cases where you have to roll the option or you might get assigned and you have to sell calls for a while until your calls get called away or excuse me, your stock gets called away through your call options. And so you might have to be in the stock for some months at a time. But so ideally, you just keep selling puts because if you never get assigned and every week the put option just expires worthless, you're just going to keep selling puts, right? So that's what we're going to do right now. Let's go over here. Let's go ahead and remove our cart. Let's do. I'm debating on doing like one for this week. I'm thinking I'll do 11 days out. So, because I think there's going to be a little bit more premium to earn if I go 11 days out. So, we're not going to have it expire this week, but we're going to have it expire on the 11th. Okay. So, that's going to give me some good premium here. And again, I'm usually looking for something that's a 30% delta. We'll talk more about that tonight. But when I click on this one, this one's a 55% delta. And this one basically has a 55% chance of expiring worthless and a 45% chance of expiring in the money. I don't want to sell that one. I want to sell one that's closer to, oh, excuse me. I want to sell puts. Sorry. I want to sell puts. There we go. 36%. That's not too bad. Let's do this one. That one's closer to 28. I'm not going to earn as much premium, but it might be worth doing just to get a little bit of a lower strike price because the market would have to drop. Let's do the math real quick on that. If I sold the 2150 put and the market's at 2265 right now, that would be 21.5 divided by the current share price at 22.65. The market would have to fall 5% for me to get assigned. Okay. So let's do this. Let's go ahead and, like I said, I think I'm going to go with the 2150 strike. That gives me close to a 30% delta. It's 28%. So there's a 72% chance of expiring out of the money, which is what we want. We don't want these to expire in the money because I'm selling the option. Um, so I have a 72% chance of just collecting that premium and I'll just keep that premium, which is really nice. So let's go ahead and sell this one. You'll see my cart right here. I've got a 39%, I've got 39 cents that I can make per share. And we'll go ahead and click continue. And I'm going to do two contracts. I usually do, if you look at this here, you'll see I have to lock up for 11 days, $4,200. I usually do trades. When I do the wheel strategy, I like to do about 10 to 12 trades at a time. And I usually lock up about $4,000 to $6,000 per trade. So it's like $4,000 to $6,000 per trade. And then I do like 10 to 12 of these at a time. Okay. So I'm just and I try to separate them from sector, which we'll talk about later. But yeah, you don't want to have too many in banking. You don't want to have too many in oil. You don't want to have too many in crypto or whatever. You don't want anything like one sector driven will. So I try to like have, two banking stocks, two oil stocks, two tech ones, two healthcare ones, just try to keep the sectors diversified, which is good. Okay. So we'll do $4,000 to $6,000. It will lock up, which is good. Yeah. So the way I do it, you need 40 to 50K. You don't have to do that way. Like when I got started, I would I would just do it with like $10,000 and I would just do one option at a time. Yeah. And maybe you can only do four sectors instead of six sectors, or you can only do three at a time, which is fine. So, yeah, which is fine. But let me show you how awesome this is, though, because if you look at this, I just have to lock up. And one, you can release this at any time. Like you can close your option at any time. But I plan to keep this until expiration or close to expiration. The reason why is because I want this option to expire worthless so I can collect that $78. Now, look at this. I'm gonna grab my calculator again here. So if I take $78 and divide it by 4222, which is that's how much I would, I'm locking up $4,222 in a cash secured put. That's going to be this. And then if I time that by 100, I'm basically making about almost a 2% return in 11 days. Okay. So that's the goal, is you want to be making about 4% a month or so in premium. That's usually where I want to be, is making 4% a month in premium. And then the potential for, when I get assigned eventually, you want the potential for appreciation on that stock that eventually goes up. So, okay. Yeah. So, I mean, that's what I'm doing. That's what I'm doing personally, Paul, is I'll lock up 40, 50, 60. Well, or like 75 grand is what I'll do in the will strategy, across like 12 different stocks. And I'm just trying to collect premium off of that money. So, okay, so we're going to do this one. We're going to, like I said, I'm going to lock up this. And when I say it's locked up, I can undo this at any time I want. I just want to keep it locked up so that I can collect that premium. So we're going to sell the 2150 put on SoFi expiring in 11 days. We can click review order. You can see right here, it's going to tell you what you're about to do. 2 contracts on SoFi selling the put. Estimated credit, $77.92. Collaterals, $4,300. You're agreeing to buy 200 shares of SoFi at 2150 on or before February 13th. If you are asked to buy SoFi by then, you'll keep your collateral on the full $78. This doesn't include regulatory fees. So as long as SoFi does not go below 2150, I'm going to collect that $78 and never get assigned, and my money just comes back to me. Okay. But again, we don't mind getting assigned because we believe in the stock. I believe in it, and I'm hoping to get assigned at some point. So that's the point. So we're going to go ahead and click submit, and it just got filled. And so now I'm in this. That's it. I'm in the first step of the will strategy right here. Okay. And then if we get assigned, we'll get assigned. If we don't get assigned, that's fine. We'll just sell puts again, and we'll come back next week and report how it's doing. And we'll probably take another trade next week. So, all right, guys, I think that's about it. We'll go ahead and click done. So we're in. We're awesome. Tonight we have that webinar on the Greeks. I'm looking forward to that. If you guys have any questions, I'm happy to answer those questions. We did go a little bit over just because there's a lot to explain, but okay, I think we're good. All right, guys, appreciate each one of you. Have a fantastic rest of your day, and we will see you guys in the next webinar. Thanks for coming.